Good evening. Welcome back to Hurdle Rate. In this video, we're going to build a DCF model for Netflix. Hopefully this is going to be quite a quick one because I want to watch Chelsea Barcelona later this evening. So let's get straight into it. So go to the SEC, open up the search for Netflix, and then open up the first 10K and the 10Q. You'll have to scroll down a bit. The 10K is fairly high up. Second, yeah, the 10K is on the third page, and the 10Q is on the first. So yeah, let's dive straight into it. Open up your spreadsheet, take away the grid lines, view, freeze your first column, insert another column in front of A. So your A column becomes B, make your A smaller, make your B larger, and in A1 type NFLX. Then go data, docs. On the 10K, the page we need is page 19 to get the financial results. On the 10Q, we need to come to page 26. So yeah, let's start building this out. It shouldn't take us too long because there's only one revenue segment, and that's streaming. So yeah, let's blast through it. Side. Ticker equals A1 dot open brackets symbol. The date today is the 25th of the 11th. 5. Formatting. The current price is A1. Open your square brackets. Price. These two we can leave for now because our model will tell us what they are. And back. Put this navy blue color on the white so it's visible. One assumptions here. Revenue segment. That is streaming. We don't need to put the DVD in just because they've discontinued it. We discontinued our DVD by mail service in the year ended December 31st, 2023. So yeah, we'll just put all of these into streaming. The revenue segment, then we want which bear base bull. So the next one will go EBIT is your operating income, your WACC is your weighted average cost of capital, and terminal growth value is what the growth rate of the company in the years after the perpetual growth rate, in the years after we've finished forecasting. We're only going to forecast 5 years out. Yeah, that looks good. Revenue build. And we're starting in 2022. So for the next cells, just put the previous cell to the 2022 cell, +1, then pull that along, and we want to go to 2030. So the first, well, the only revenue that we need to look at is streaming, but put it equal to your cell that you have here. For me, it's B10, And that means if we ever update it up here, it will automatically update down here. Then just do some formatting on the number style. So go select these cells, go number, use a square bracket for negative numbers, use a thousand separator, and go to 0 decimal places. Okay, so Netflix reports these in thousands, but we're going to do the spreadsheet in millions. So this is 31,469 that we're going to put 0.852. So we're not going to display it in the same way, but we're going to just do this total here for these two, because we're not going to factor in the DVD revenue because it's not relevant anymore. That's mad that even in 22 and 23, they were still doing 145 million, 82 million in DVD revenue. 1, 2, 3, 7. Then we go 36. We want to also know what the growth rate is. You just take the year that you're in, divide it by the previous year, and minus 1. Along for 2025, come to page 26, and it's this line down here. So we want to take the 39 divided by 28754. You know what our multiplier is? 1.3, about 1.356. There we go, equals 33,132.274 multiplied by 1.35634,526. Wow, so that's the last couple of years has seen very good growth. We're going to simulate the base, bear, and bull case scenarios now. And to do that, for our base, we're just going to take the average of the last 3 years. Then in this final one, we will put, if we say that this eventually, the base case eventually comes down to 10%. So equals E10. Format this to a percentage and decimal places. The way we're going to calculate these figures here now is we go equals, you take the previous year, subtract, open brackets, take the previous year again, minus the final year, close your brackets, divided by your final year minus the previous year, close brackets. And because we're going to copy and paste this when we're using the EBIT, we want certain parts of it to be fixed and other parts of it to be dynamic. So on this one, we want the column to be fixed. So we go put the $ in front of there, but we want the row to be dynamic. Then this final year 2030, we want it to be fixed. That will always be the same. Then this one, we want, what do we want? We want the row to be the same, but the column to change. Do that. There we have it. Now pull it along. And we'll say the bear case for Netflix, we'll say it's 95%, and the bull case being 105% of this figure. So this figure here, that on the bear case, it will be 9.5. On the bull case, it will be 10.5. So what we do now is we take, for this bear line, we take the base, we multiply it by the bear figure, and we lock in this cell. Then we just copy that across, as so. And we do the same for the bull case. We lock it in, pull it across, and there we have it. Now, to be able to flick through these different growth rates, we go into the cell on the growth rate for the forecasted revenues, and we just go equals. we use the offset function. The first thing we do is we select the cell that we're in, G22 for me, then comma, and we select the switch, comma 0, close brackets. And then you just lock the switch in. It's going to give us a, it's what we need to do in here is we need to put a number between 1 and 3. 1 being the bear case, 2 being the base, and 3 being the bull. We're going to leave it on the base case. So as you can see, it replicates this one. The date, but let's this. We go, and if we go to 1, you can see it changing. 3, it changes. Just need to format it like the into a percentage, and there we have it. To forecast the streaming revenues, you just take the previous year, multiply it by 1 plus your growth rate, and pull that along. There we have it. So remember these figures, 5562. If I go on a bear case, comes down 5281 now. If we go on a bull, you can see it goes even higher. So yeah, that's what we're going to do. We're just going to flick between these to give us different scenarios, and this will affect our implied price up here. So next, let's just do it. We don't need to, but to be neat, we can just put a total. Normally we have multiple revenue segments if this is your first time watching. And then we do a sum at the bottom. But we'll stay in the habit of doing that. And then on another video when I have when we have more revenue segments, so we just go equals sum. Hold it, pull it along. Okay. Now the next section is the income statement. The first line is revenue. Just put it equal to this one. Pull it along. Just pop another line under him. We'll do the growth rate. Go. Okay. Below this one, we want the EBIT. Then we want taxes. Put taxes below because we want to know what this is of EBIT and percentage of revenue. Okay, so let's come up to the income statement, which is this one here. So page 24 on the 10Q. On the, oh great, they put it here. On yeah, that's fine. We'll use this one. Actually, come up to the actual income statement because we want to see the tax. That will be on, where is it? Here we are. Operating income here. 5632.831 6954 and 417 4. So percentage of revenue divided EBIT divided by revenue. 2025. Also, again, let's have growth rate here. Bit. So we know that and 418 divided by 8144.848 gives us our multiplier, and 369.940 multiplied by 1.790433. Okay, oh, so it looks quite good. EBIT, operating income, seems to be increasing again. For a long time, Netflix had very high margins, but then competition came in. But it looks like they're going up again. They seem to have fought it off quite well. Okay, so income. Let's do come back to the 10K. Provision for income tax. We need. Go. 772.005. 797. 14.026. Take this one divided by 988,365.365. 1.7 multiplier 1392 multiplier 68788. They're paying about 13% tax. And then you take your EBIT, forecasted EBIT, and multiply it by the tax rate. Then we do that. We just put it across. So we are, I mean, here is sort of forecasting based on the average of the last 3 years that EBIT will be high this year, then it will go down a bit next year, but then it will start to come up. We just do the averages. There's no, I guess, real fact behind that. It's just based on what the average is. Then we go for cash flow items. And these are your depreciation and amortization. You want to know what this is as a percentage of revenue. Percentage of CapEx. And we have CapEx. We have change in net working capital. Okay, so to find these, you have to come onto the cash flow statement. On the 10Q, they're usually at the top. The 3 statements: the income statement, the balance sheet, and the cash. Income statement. And this is the cash flow statement. Balance sheet is here. Okay, so we need this one, depreciation and amortization. That we sum this to get our change in net working capital, and then purchases of property and equipment. We ignore these ones. I think just focus on this, and the capex down here. So let's 2022. Wrong page. We go 2022. So 336.682. Yes. 356.947. 328.914. But this is of your revenue, about 1%. X is these three here, 407, 348, 552, 439, 58, and it's about 1%. Change in net working capital. So equal sum, start here, negative 353.834, negative 158.543, negative 55.513, 27.35, negative 217.55. Again, equals negative 181 sum, negative 181.03, 93.502, 103.565, 178.708, negative 310.92. And the final one for the 10K, it's 191.897774, negative 461. Go onto the 10Q now. So if take 329 divided by 247.406, so no, I did that wrong. 249,375. 1.318, so equals 47.406 multiplied by 1.31895. Find out what the DNA is as a percentage of capex. You just take the figure and divide it by the capex. Just pull that along. Take an average of the last 3 years for depreciation and amortization, pull it along, and you go revenue multiplied by your A. So we have it. Do the same for capex now. So we take 440 divided by 280.864, 280.864. Now you take 448.885 multiplied by 1.56494958. An average. Just go revenue multiplied by the percent of revenue. There you have it. So change in NWC, net working capital. Let's go equal sum and just sum up these ones here. 476 points. No, it's negative though. Point 329,203.82 negative 550.473. Take an average of the last 3 years, then just multiply it by the revenue. There we have it. Okay, now we go on to the DCF. Five minutes until kickoff. Let's go. Okay, EBIT. We're going to do a bear, base, and bull. So just actually, let's just copy this down. Well, equals B12 percentage of revenue. Bear, base, bull. What we want to here is we want to put this equal to our EBIT. Pull that along up to here. Then we go there. And so if we forecast the EBIT margins to eventually, I mean, if they're at 30% now, what should we say? Let's go with the forecast is that they're actually going to increase the margin, the EBIT margin. So let's put it up to 35%. G12. This needs to change now to the revenue is, so the EBIT is the revenue multiplied by the EBIT margin. Pull that across. This needs to go to, well, let's put this at 90% because it could go either way, and this one at 110. I think there's probably a lot more volatility on the margin rather than the revenue. Again, we're going to just put the 2 here. Okay, let's just check. Yeah, everything is, it's in order. Yeah, okay. Then obviously taxes. What goes is percentage of EBIT. Taxes equals, put it equal to this one. Do the what we wrote before and just put it along to 2025. Pull this along. Then average. There we go. Take your EBIT and multiply it by the tax rate. We go. Now that we've linked these together, it just means that every time we change the switch, the taxes will adjust as well as the EBIT. Now, towards we're closer to the end than the beginning. So let's go EBIT, which is your earnings before interest but after tax. The way we calculate it is you just take the EBIT and subtract the taxes. Fold it, pull it along. Now, we go DNA, X, change in net working capital. Just pull these down from what we've got up here. Go here. Now, unlevered free cash flow. We can calculate this now. And the way we do that is we take our EBIT, we add back in depreciation and amortization because it's a non-cash expense. We then subtract capex and we subtract the change in net working capital. That gives us about 11 billion, or just over 11 billion. And yeah, we pull that along. The next thing that we need to know is the present value of unlevered free cash flow. And to get that, we need our weighted average cost of capital. So let's calculate that. Open up another sheet. I'll zoom in a bit. Make your A a bit smaller, make your B a bit bigger. Again, page layout. Let's remove those grid lines. You don't need to freeze anything though. Type in NFLX or Netflix stocks. The first thing we need is, the weighted average cost of capital, WACC. What that is, it's your percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. And we just need a few line items for this. The first one is market cap. We can calculate this by going equals A1 dot, open your square brackets, market cap. Remember to divide by 1 million so that it fits in the cell and is in line with what we're with how we format it. Then the next one is percentage of equity. We can't calculate this just yet. Neither can we calculate the cost of equity. The cost of equity is composed of three components: the risk-free rate, the beta, and the equity risk premium. The only one from these that we know is the risk-free rate, and we use the US 10-year bond, which is 4.005 at the moment. These two we can't calculate yet. Then we want debt. Cost of debt. Tax rate. Sorry, no, percentage of debt. There we go. Then put total here. Then WACC. Okay, so the debt we find on the balance sheet. So go into the 10Q. We want the latest of this 10Q is the latest one available. So this is the most recent balance sheet. And to find the debt, we go short-term debt and then long-term debt. So there's no short-term debt at the moment, but there is this long-term, which is about 14.5 billion. But 14,463.020. Now we can get our total. Let's go 45299, and from the total, we can calculate the percentage of equity and the percentage of debt. So you take your market cap divided by your total, and that gives you the percentage of equity. Then you take the debt divided by the total. That gives you the percentage of debt. the cost of debt, we need to look for their interest expense. So about 540 million for the first 9 months. So what we'll do is we'll just go 542.115 divided by 3 multiplied by 4 to get an annual amount. And we just go 72.82 divided by the debt, and that gives us about a 5% of debt. The tax rate says we'll use that one. If not, we'll just use this 13% that we've been working with on the other. Where is it? Taxes. Effective tax rate 14%. Now let's do the beta. The beta is quite easy to do. We just need the industry, the unlevered beta for that industry, the revenues, the EB to sales, the next one, EB to sales, we want value, proportion, then weighted beta. But to be honest, I mean, this is how we would do it normally, but we know that there's only one industry, so we're just going to take the unlevered beta from that. We don't need to work it out properly. Again, I'll show you how to do it when we're on another one that has multiple industries within its company. And then I'll show you that, but for right now, let's not be too, because otherwise it's yeah, the match is going to start in a bit. What would we call it? Software internet. And even though it might have different, so it could be software internet, it's got an app, etc. We're looking at, for the equity risk premium, we're looking at where it generates its revenues from, and that would be cable TV. You know what? It's probably cable TV, even though that's the antiquated way of doing it. So the unlevered beta, so it's 0.59. That's the beta we'll use. Then equity risk premium. So ERP, we need region, revenues, ERP, weighted ERP. Yeah, let's take this down. Here it is. 9 months. This is what we won. Okay, so this should be, so the US. Let's call it let's call it North America because it's easier than on this. EMEA, LATAM, APAC. Revenues, so 14,617.882. EMEA 10,614.903. LATAM 3939.582. 392.907. And the ERP is okay. We know for North America, so US and Canada, it is North America here 4.58%. For EMEA, 6.22%. LATAM, Central and South America. Yeah, 9.30. I'll zoom in a bit so you can. Okay, so we're going to go with Central and South America, 9.3% for LATAM. And for APAC, we will say, no, we'll just do 5.92. We'll do the for Asia. And so the weight, we need to know what the sum of these are. So the weight, you just go the revenues divided by the total. Lock this one in. Pull them down. And you just do your ERP multiplied by the weight. Pull it down. Equals sum. There we have it, 5.83%. Okay, now we can do our WACC. Actually, we need to do our cost of equity first. So your cost of equity equals the risk-free rate multiplied, no, sorry, plus your beta multiplied by the equity risk premium. So you take your risk-free rate plus your beta multiplied by your equity risk premium. Bottom width 10. Now the WACC equals, so your percentage of equity, you do this in brackets, so your percentage of equity multiplied by your cost of equity, close brackets, plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. There we have it, 7.34%. Now come back onto the other sheet. Yeah. And put this cell, the WACC cell, the base WACC cell, equal to the WACC we just calculated. For the bull case, you subtract 0.5%. For the bear, you add 0.5%. The higher the WACC, the greater the risk. Then 2.5% for the terminal growth value. For the bear, you subtract 0.5%. And for the bull, you add 0.5%. And we're going to do another switch here, but instead of, so this will be the switch, but instead of it using offset, we're going to use choose. So just select all of these in order. Okay. There we go. Looks good. Okay, we're not long now. I'm probably missing the Champions League anthem. So to find the present value of unlevered free cash flow, you take the unlevered free cash flow, multiply it, divide it by 1 plus your WACC to the power. Okay, we need to put it as this cell here. And what we're going to do is just add a so put 1 there, and then equals plus 1, pull it across. Yeah, lock in your WACC because we're going to pull it across. Sorry if this is at the bottom of the screen. Go. Yep, that's fine. Okay. Now we need the terminal value. And the way we get that is you take your final year of unlevered free cash flow, multiply it by 1 plus your terminal growth value, close brackets, divided by your WACC, subtracted by your terminal growth value. This is saying the terminal growth value is about $490 billion. The present value of terminal value is, again, we just take the terminal value divided by 1 plus the WACC to the power that final year, which is 5. The next step is to calculate the enterprise value. And all that is you go sum, you take the present value of terminal value, and all of these present value of unlevered free cash flows that we forecast. Then the next step is we want to add the cash back in and subtract the debt to get our equity value. We know what our debt is because we've calculated it for the WACC. But we want to know what the company has. So to the top, find the balance sheet. Here we are, cash and cash equivalents. So 9287. So it's about just over 9 billion in cash. 87. Now the equity value equals, you take your enterprise value, you add back in your cash, you subtract your debt to give us. Then we want the diluted shares outstanding, then implied share. We just need, let me just check something because it recently had a stock split in it. So I don't know if this is the right amount of shares. Okay, so now they have 4 billion shares. So we'll just use this figure. I mean, is it divided by 1 million? Okay, we'll take it as this will be what we'll say is 4352. 4352. And the implied share price is, take your equity value and you divide it by your diluted shares outstanding. And that's saying it's $94 a share. So obviously this was a post split, which is not far from where it is right now, I don't think. So K91, yeah. Equal. Okay, so yeah, it's not far from fair value if we trust this model. The bear case, we would say 68, the bull 13332. Okay. Yeah, so I mean it's 10% off its fair value. So let's watch this one. And again, remember this is not financial advice. Yeah, I'll see you on the next one. Please do subscribe if you haven't already. Yeah, have a good evening, everyone. Thanks. Bye.